Hello everyone, welcome to TSAM Digital. I'm Amy and today I'm joined by Brunno Maradei, who's Head of Responsible Investment at Aegon Asset Management. So welcome Brunno, it's great to have you.
Hello Amy, thanks for inviting me.
Okay, so let's kick off today. Before we start with this discussion, do you want to tell us a little bit about your background, your career and what you're focusing on this year?
Yeah, so I've been in the investment industry for a long time now, over 20 years. And I started out really at Iris, which is now Vigeo Iris, which is now Moody's. So a very long time ago, back in 2004, I joined Iris as the head of their client team. So I've been in the ESG game for quite a while. And after that, I spent some time in development finance in the World Bank in Washington, and then after that in the European Investment Bank in Luxembourg. So for me in 2019, it was really a comeback to the fund management industry. And part of the reason why I came back was because I thought impact investing is really starting to kick off in the private sector. And so it was really interesting for me to come back to the private sector, the fund management industry, in the ESG space, and particularly focusing on impact investment, which I think is really exciting, the way things are evolving in our industry at the moment.
That's fantastic. And yeah, given your experience, I think it's no surprise that today we'll be talking about impact investing in ESG. So on that note, given that you're in a prime position to shed some light on this, would you mind kind of telling us what the main ways investors can have a real world impact in globalized liquid capital markets?
Well, large institutional investors like ourselves, shifting capital between different bonds or shares in the secondary market isn't really impactful unless you can reach a certain level of scale where you start to have potentially an impact on the cost of capital for companies. Where the real impact is for investors like ourselves, it's really about engaging with companies and signaling your expectations of those companies from an ESG perspective. That's where investors can really add value here and really have a positive impact in the world. It's about the nitty-gritty work of going to talk to each of the issuers that you invest in about their business. It's about building a relationship with those companies or those issuers more broadly, and really communicating your expectations as a shareholder or bondholder in terms of their environmental, social, or governance performance, whatever your standards may be for those. So I think we have several examples in our portfolio today of successful engagements where we've really managed to build successful dialogues with companies to move them in the right direction towards a greater net positive impact in the world.
That's great. And so you mentioned about signaling and communicating with those stakeholders. So is that something that you've done in-house, or is there kind of industry-wide standard for this?
Yeah, it's a good question. So there are several players out there who are offering these services to asset managers today, and there are some very respectable service providers there who are offering these kinds of services. We think there is value in partnering with other investors when you're engaging, for sure. Generally speaking, particularly with the larger companies that we have in our portfolio, issuers that we have in our portfolio, we are relatively small in terms of the shareholding base or how many bonds we hold, in terms of their balance sheet overall. And so if you're able to partner with several investors, then your leverage is that much greater and your voice is that much louder when you're coming to speak to companies. Now, do you do that through a service provider, or do you do it yourself? At Aegon, we feel it's very important to have control over this, and we think that's actually can be a source of insight and a better holistic understanding of the issues that we're investing in. So to outsource that, we did outsource it for several years, but to outsource it now would be missing a trick, in my view, of being able to actually be in control of that situation, of having impact directly ourselves, and of learning more about the issues that we're investing in.
Yeah, that's a very valid point. And obviously you'll know from doing it yourself. So moving on then, so when we think about active ownership as a principle, whether you do that in-house or have support with that, how can asset managers align their active ownership strategies with ESG incorporation of a portfolio?
So it's really important to have a program that not only talks about your expectations on ESG from the perspective of your clients and their standards, but also to have a program that really considers the financially material, environmental and social and governance topics. And that, I would say, is still the vast majority of our engagements are around issues that we deem to be financially material. And we find those financially material issues when we actually perform our in-house research on ESG. So we have our own proprietary ESG risk categorization on the credit research side. On the equity side, we also categorize ESG risks and opportunities for every issuer that we look at. And as part of that, we come up with some engagement objectives that then the engagement team can proceed with. It's very important to have clear objectives. It's also important to make sure that your feedback loop is closed. So it's not very healthy to have the engagement happen somewhere else, either out of the house or in a very separate, segregated team. It's always important to bring in the investment team so they can actually not only lend their expertise in that dialogue with the company, which lends credibility to that dialogue, but also to hear it directly from the horse's mouth, so to speak, what the company is saying about their ESG performance, and to incorporate that information in your overall research analysis, investment analysis process. So I think that's very important to have it fully integrated into your investment analysis and decision making.
Amazing. And you touched on credit and equity there when you were talking about investments. So bringing it into a kind of different direction, shall we talk about private debt markets? Because I know that's something that we've not really explored a lot on this channel, and something that you've mentioned to me is interesting in the context of ESG. So when we look at integration, how does that come into the debate?
So I come from a development finance background. I spent 11 years in the development finance industry, where really our bread and butter was private debt. And so our approach in development finance institutions is something that the private sector needs to start replicating themselves. Of course, the pressures on margins are greater, so you do need to find shortcuts where possible. But overall, I would argue that as an investor in private debt markets, you still need to be doing pretty significant ESG due diligence, particularly because you have a fiduciary duty to your clients, and there are several environmental, social, and governance issues that are financially material to your private debt investment. So you should be aware of what those are. You should be asking the pertinent questions. Asking those questions will add to your understanding of the deal that you're about to get yourself into, and how well managed that particular project might be, or that company. So it's actually very important to do that work yourself. Should there be no third-party information on that issue, which often with private debt markets, there isn't really much to go on from third parties. So we do that work ourselves at the moment, and it's usually done in the investment team with some support from the responsible investment team as well, for particular expertise that we might have on certain ESG topics. But it is important that the investment manager, the fund managers themselves, are fully in charge of this process and are fully familiar with the ESG risks and opportunities that each investment presents. And what we've done internally is develop tailored questionnaires depending on the size of the deals that you're doing, and the type, the sectors, the regions. It has to be adapted to the context of the investment strategy that you're undertaking. So you shouldn't be asking the same set of questions to small and medium enterprises in the Netherlands versus asking the same for insured private credit in emerging markets. That would be a very different set of questions and very different risks that you're facing. So you need to get at the heart of what those material issues will be, and that needs tailored thinking about what are the right questions to ask in that ESG due diligence process.
It's a very interesting point. It actually brings me on to my next question, because we often talk about what the client wants, but we don't talk a lot about the borrowers or the ones who should be doing the due diligence on. So given that you do have those tailored questionnaires, in your experience, do the borrowers often kind of engage with the concepts of ESG well? They're kind of happy to cooperate, or does sometimes they not even understand that they're not necessarily meeting that criteria that asset manager would expect to see?
It varies a lot depending the market that you're looking at. You know, some clients are extremely well versed and very familiar with the concepts, very able to answer the questions directly. For example, an emerging market borrower who might also be borrowing from development finance institutions will have heard the same questions before, will probably be quite well prepared for the kinds of questions that we're asking. Having said that, a small company in the Netherlands may not have the time or the bandwidth to even think about certain environmental and social issues. They're busy complying with regulations already. So to a certain extent, you can rely on regulations as well. So you have to be very selective about what else you want this company to be doing apart from complying with regulations. And then there's the point about, okay, to what extent do we want to handhold our borrowers through this process as well? And here it's something that you have to make a judgment call on this. It's always a little bit tricky to the extent that you are helping your borrowers, you may be absolving them of control and liability for these environmental and social and governance issues that they have to manage. So you have to be a little bit careful not to cross over that line if you are helping your clients along the ESG journey that people speak about so much these days. You have to make sure that, you know, they also have some ownership of it and they're able to actually drive the processes that are necessary there. So that's a fine line to tread, but we do think still education and support is very important for some borrowers, for sure. We do need to help them along the path, and we're happy to do that. We think that's part of our value add as an investor in these companies.
Yeah, absolutely. I can imagine that, as you say, you kind of want to get involved, also let them, you know, take ownership of it themselves. So as well, you mentioned about how, you know, the borrowers are also dealing with a lot of regulations and complying with those. But on the other hand, we've got kind of a lack of regulation when it comes to ESG in general in the asset management space. So do you think having a more solid regulatory framework will make it easier for investors to identify private credit and private debt as, you know, meeting the ESG metrics that they need? Or do you think it's more a case-by-case basis, like you with your tailored questionnaires and things?
In the private markets, it's hard to see how regulation can really play a very solid role in getting that done. I mean, I think what could regulators ask us to do? They could ask us to do pretty much what we do today, which is environmental and social and governance due diligence, to be somewhat aware of the risks and opportunities. They could ask us for evidence that we're questioning our projects and our companies on these topics, that we're monitoring them over time. So all of that will serve to give, I feel, investors more protection over the ESG processes. It could also backfire somewhat if you get too prescriptive about what it is that you're asking investors to do, private market investors to do, because it is such an enormous market and so enormously diverse as well, that it would be very difficult to come up with a set of ESG criteria that you need to go and question every company on. You know, it's some of it is bound to be not so relevant for others. So, you know, I think the high level principles of ESG due diligence, for sure, it makes sense to regulate that a little bit more and to impose those requirements on investors. But if it got too prescriptive, similar to, let's say, a taxonomy-based approach, then I think it could potentially backfire, just add unnecessary cost, and really it would become a tick the box exercise. So it's a difficult line to tread, and I see why regulators are struggling with this in private markets particularly. Now, the regulation in public markets makes far more sense, right? It's to standardize disclosures by companies approaching capital markets is always a healthy thing to do. You know, we saw the benefits of convergence in accounting standards and in disclosures across global stock exchanges and markets, and how that benefited globalization and global portfolio management. So I think all of that has been very healthy overall, and not without its flaws. Of course, we still have the scandals going out there. You know, nobody can stop fraud completely, but it is much better than it used to be. And a similar story needs to be followed for sustainability. If we're really serious about embedding sustainability in the processes of investment decision making and portfolio management, then we need to help those public markets really start to standardize those disclosures and standardize the way that we look at all of this stuff in public markets. Private markets, much more difficult to do just because they're so much larger and so much more diverse, I would say.
That makes sense. And yes, some excellent insight there on private versus public markets. So hopefully we can explore this more at TSAM ESG on the 2nd of November. I think it'd be really good and then kind of untapped discussion that we've not really delved into before. So I think we've run out of time, but thanks so much for shedding some light on this issue. And I look forward to catching up with you soon at the events in person.
Well, thank you, Amy, for inviting me for this interesting interview. Thanks.